Welcome back to the Pile Up Real Estate Podcast, everyone. Today we're talking with a good friend of mine, Conor Gatlin. He has done several investment properties from long-terms, a couple of mid-term rentals, which we're going to focus on, some short-term rentals, and has even scaled up to doing a 7-unit and a huge hotel with partners. So it's going to be a really good episode. You're going to learn a ton of stuff about how he scaled and a lot of stuff about mid-term rentals, what to do, what not to do, and how to make sure that you analyze a property correctly. We're going to have a quick ad and get right into the episode. In real estate, first impressions can make or break a deal. Whether you're listing a home for sale or marketing an investment property, having high quality photos are key at grabbing attention. If you want to stand out in the competitive Colorado Springs market, having high quality photos is essential. And Wayne over at Hamadi excels at getting the best possible photos for your property. He is based right here in Colorado Springs and specializes in capturing properties in the best light. If you're ready to take your property photos to the next level, make sure to contact Wayne over at Hamadi and mention you heard about him from Tanner at Red and Joy Real Estate to get 20% off your next shoot. Remember, great photos can make the difference between a quick sale and a stale listing. So make sure to contact Wayne over at Hamadi today. Conor, thank you for joining me on the podcast. I'm excited to have you here. We're going to talk some cool real estate stuff, what you've been working on for midterm rentals and a cool hotel deal. But first, give us a little bit about how you're doing and a little bit of background on you.
Yeah, thanks for having me on. Excited to be here. So, I'm doing pretty well this week. Little background on me. I live here in Colorado Springs, grew up here. I'm a full-time software engineer by trade. That's what I studied in college, and that's what I've been doing for about the last 10 years. But I also have a side business in real estate, and I know we'll get into that more in the podcast. But we've been doing that. My wife and I have been growing that business since we got married. We've been married almost 8 years now, and have been diving into a few different realms of real estate, short-term rentals, midterms, like you mentioned, long-term rentals, a hotel deal, different things like that. So consider myself a full-time software engineer and a full-time business owner. So yeah, we'll dive into a few of those things, I'm sure, today.
Yeah, sweet. So whose idea was it first to get started in real estate, you or your wife's?
I would say it was my idea first, although she has been very supportive and she jumped right on board. But I really wanted to do real estate from a young age. My grandpa was in real estate. He bought properties in California back in the 50s, 60s, and 70s before, all that land appreciated. And so he had about 50 properties, and he ran his own property management company, and he was a broker, and he did all the things. And so I think growing up,
It runs
watching
in your
him,
blood, basically.
yeah, I think it was just cool seeing him and my grandma and the life that they lived, and the way that they were able to be generous towards people. I remember went to my grandpa's funeral because he's now passed. And, you have obviously friends and family there, but the cool thing was seeing the business partners, the employees, and even the tenants that came to his funeral and just
Wow.
spoke like the impact that he had through his real estate business. So definitely something that's been, in my blood, I guess you could say, or something that I've wanted to do for a while. And my wife graciously came on board, and she's all on board at this point now.
Yeah.
Yeah.
So when you first got started, what was like the first deal that you jumped on? What did you think was the best way to get started after seeing what your grandpa had done?
So we got started pretty simply, and I'll say that our start was just with our first house purchase. Kind of coming out of college for both my wife and I, we realized this 9 to 5, 40-hour a week cubicle job was not something that we had dreamed of, or not something that we necessarily wanted for the next 40 years of our lives. So we knew we wanted to go somewhere, but I think we had to start very simply, as most people do, and that was just finding the first house that we can actually live in. And I know a lot of people don't, categorize their personal residence as an investment. It's more of a liability, but I think it gave us that first step into, okay, we know how to get a loan. We know how to run numbers just for our personal property. We know how to run finances for our personal lives. So that was our first, I guess you could call it deal, although we were just living in it. We weren't house hacking at the time. We
Okay.
weren't doing anything
So
special.
no roommates or anything.
Not at that point.
Mm-hmm.
But as we dug into it, that's when we started getting into the Bigger Pockets podcast. We started reading a bunch of material, watching all those HGTV shows, and really getting inspired to go beyond that into some of our next deals and eventually house hacking down the road.
Mm-hmm. Did you have in the back of your head when you bought this one, like, okay, we're gonna buy this one with the intent of moving out and renting it?
Yeah, so I'd say we had that intent initially, although I think when you're first starting off, you don't have a lot of money, and so everything seems so far away. Like, it took us so long to just build up the down payment for our first house that we thought, okay, we want to eventually rent this out, but it's going to take 3 to 5 years to build up the down payment and buy our next property. At that point, we weren't thinking about creative ways to do anything else with investments, and so we had the intention, but it wasn't like an immediate intention. And then part of that too, we weren't all on board into the house hacking. We weren't all on board into this is going to become a lifestyle and this is what we want to do full time. And so there was, some back and forth of, hey, we're pretty comfortable in this house. We like it. Maybe we could raise a family in this house. So there was still some introspection going on during like the first couple of years that we had that house of what do we actually want to do? Where do we want to go while we're building up down payments or more money for the next deal?
Mm-hmm. So what did you end up deciding on your next deal, and what did you do with the first one?
Yeah, so we bought our first one in 2017. The next one was not until 2020. So we ended up staying in that house for 3 years. And by 2020, market had appreciated like crazy. We had a lot of equity in our home, and at that point we could rent it out for a lot more than what our mortgage was. So we thought this is a no-brainer. Let's go buy our next house, and we bought a bigger house. It was a nicer house, and I think our mindset even at that point was still, hey, let's go, enjoy where we're living. Let's just try and buy another property, and then maybe we'll buy investments where we're not living in them later down the line. So I think our mentality still was, hey, this is another property we could live in 3 to 5 years. We could raise a family in this house as well, but we still have to build up a down payment. And so I think that second house is kind of when our mindset shifted because we realized the pace that we were going from 1 to 2 was pretty slow. That three
Yeah.
year period, build up a down payment. It's great, and the market appreciated, so it worked out well. But we realized that's too slow of a process for where we wanted to get and the things that we wanted to do. And so at that point, we kind of made the decision, hey, let's go all in. Let's start moving every single year. Let's start house hacking. Let's really escalate and try and make some progress in our investments.
Mm-hmm. So we have a bunch of friends that also house hack, and like
Yeah.
Jordan, Jacob, Michael, and Luke. Were you friends with them during this time? And like, did you kind of like get the bug from them and having like a good like-minded group of where you wanted to be in life and kind of just did it together?
Yeah, I think that is actually key. And I'm glad you brought that up because when we bought this second house, we started getting plugged into this group of guys. Actually, as a group of couples that they were all kind of investing. They were all doing house hacking. A lot of them were doing short-term rentals, and it was really cool to get plugged in with that group because it was motivating. Everybody shared ideas. Everybody shared what they were doing at that time in terms of investment, whether it was, hey, we're buying this house and cottage and we're going to rent out the cottage, or hey, we're living in this basement and we're going to do an Airbnb up top, upstairs. And so it was motivating. People shared ideas, and it wasn't as scary as just doing it alone. And so I think that's been critical to our whole journey is finding a group that is motivating us. And I'm sure you'd say the same thing.
Yeah.
A group that pushes you along, and then a group that you can uh, bounce ideas off of and run numbers by and go through the risk analysis so that you're not just making this decision in a vacuum.
Mm-hmm. Definitely. So, do you have if you're planning to get photos done on your next listing or rental property, don't forget to reach out to Wayne with Homati to get 20% off your next shoot. Give us a little insight of what your portfolio is right now, and do you have a favorite deal that you've purchased?
Yeah, so like I said, we bought those first two properties and then we moved quite a few times the next couple of years. Pretty much every single year after that, we'd go move into a property. 12 months later, we'd go rent it out and move into the next. Amidst that time, we did a few different flips. And the
Oh,
main
okay.
reason for that is we started getting a little bit more creative because we were running out of money. So um, you've heard of the snowball effect, right? Where
Yep.
the first the first house is probably the most difficult to buy. The first down payment is the most difficult to come up with. But once you get the ball moving a little bit, you can utilize the equity in these old properties, and that's kind of what we did. We used some equity that we had in the form of HELOCs. We did some flips to recover some cash that we can move into the next property that we wanted to live in. So we did that for the next couple of years. Right now, we have two long-term rental single-family homes. We have three midterm rentals. We have two short-term rentals, and then we bought a 7-unit apartment building with one of my good friends and business partners, and that was a couple of years ago. And then most recently, we bought a 25-unit motel with another good friend of mine, and we're looking at doing more of that in the coming years as well. So that's kind of
Mhm.
where our portfolio sits. We've gotten into a lot of different types of real estate: long term, midterm, short term. Now bigger hospitality deals, and so we've gotten to experience a lot of good stuff. But I think the experience has helped us analyze deals and know different exit strategies as we do analyze deals.
Mhm. Is one of them
Um,
your favorite that you've done?
Yeah, so I think my favorite, honestly, is the our primary residence right now,
Okay.
the one that we currently live in. And the reason I say that, it was a single family home, and so I could say, hey, it was this big motel deal that we did. But the reason I say our current property is because we get to enjoy it. We've built equity in it, and then we're also house hacking it, and so we don't have any mortgage payment. So I can break it down a little bit. We found this property in 2023, in the summer of 2023. It was a single family home built in the 1940s, and attached to that single family home was this brand new 4-car garage with a 1,000 square foot studio space above the garage. So the owner, for some reason had a real knack for garages and studio space. So they built this in 2016, and then they had a separate pool house on the property. So it was like a third of an acre. And the main house was a total disaster. The pool house was a disaster. It was, fungus growing in the middle of the pool.
Yeah.
The pool heater was out. The pump was out. All the major parts had to be replaced. So it wasn't super attractive to a lot of buyers because it was going to be a lot of work, but we saw a lot of potential in it. So we purchased it for about 690 in 2023. We got about 30K in concessions because at that time the market was pretty favorable towards buyers, and so you could get quite a bit back. And we were able to use that 30K in renovations too. We ended up putting about 200 total in renovations into the property, and that included a full remodel gut of the main house. We built out a 2-bedroom, 1-bath ADU above
Nice.
that garage space and that studio space. And then we completely renovated the pool house, did a new pool liner, pump, heater, all that stuff. Um, and so, all in, I think, what were we at? 860 after renovations
Mhm.
and purchase price. And right after we renovated, we got it appraised, and it was appraised at 1.1 million.
Awesome.
So it's a
Wow.
huge gain, like 250,000 in instant equity just from the renovations that we had done,
Yeah.
um, which was awesome. But then the reason I say that I love this deal the most is because now we get to enjoy it. We get to use the pool house whenever we want. There's a hot tub on property too, and a fire pit. and all these cool places. And then we have the ADU, which we rent out as an Airbnb, and that brings in money, enough money to cover the mortgage as well. So we get to live rent free in this really cool, newly renovated house. And then we've also been able to build up equity with the renovations that
Yeah.
we've done.
Wow, that is really, really cool. Did you know that, like, did you know it was going to appraise that high? Like, did you look at comps and kind of like, yeah, I think it is going to appraise this high, and that it was going to, really make sense to do that?
I I wish I knew, for a fact that hey, this is going to appraise this well.
Yeah.
The problem was there weren't a lot of comps that
Mm,
had a four-car garage that were really nice, renovated downtown, that had a pool house. So I think that's part of the risk-taking aspect
yeah.
of real estate investments is you can run your numbers, you try and run them conservatively, but then there's also always in the back of your mind, hey, this could turn out a lot better than we expected. And I think this is one of those deals that did turn out a lot better than we expected. We ran our numbers obviously a lot more conservatively than what I just shared. But that's the cool part of real estate. Sometimes it surprises you and surprises you in a good way, where you make more or you have a better gig than what you originally signed up for.
Mm-hmm. Cool. So you
Yeah.
also do long-term, mid-term, and short-term. Is there a strategy that you like the best between those three? And we're gonna dive in on mid-terms, but I'm curious if there's one that you like a little bit better.
It's a good question. I think um, I think there's pros and cons to all of them. Short term is probably the most work, but there's the most opportunity for profit. But what I will say with that is that there are a lot of regulations coming down in each city, zoning requirements that are changing, um, that are less favorable towards short-term rentals, as you probably know. And so that's why we've steered a lot of our investments, at least in Colorado Springs, towards midterm, and then some of our original investments towards long term. So I'd say we love short term because we love hospitality. We love being able to offer people an experience of a stay and something that they're going to remember and something that they're going to make memories in. I think that we've done a really good job and been able to take that same concept into midterm rentals. Um, but again, there's give and takes because you can't do short term rentals everywhere,
Mm-hmm.
and there's a lot of regulations that are coming down. So, and that's part of the reason we can even get into this a little bit later. It's part of the reason we've moved towards motels and hotels
Mm-hmm.
because we avoid a lot of those regulations that are coming down on the single family homes, or the
Yeah.
the smaller multifamily zoning districts.
Do you think it's good to have a good variety in your portfolio of long-term, mid-term, short-term, and then doing the motel stuff and with your primary and all that, to kind of diversify everything? Because you don't know what's going to happen in the market for the
Yeah,
future. If they could close all short-term rentals like they did for a brief period in 2020.
totally.
Kind of keep
I
your options open.
I absolutely think that diversification is important, especially in the real estate subclass. So, not only for like a restriction that you just mentioned during COVID, right, when all short-term rentals were banned, but just when you're analyzing deals too, right? Deals can go awry. You need multiple exit strategies, and if you're only versed in one specific exit strategy, I only ever do long-term rentals, then a lot of deals are not going to work out for you. Or when things get rough, you're not going to be able to pivot pretty quickly. And I have a few cases, right, with some of my long-term rentals that the numbers may not have worked out the way that we wanted to. And so we've been able to pivot to a midterm rental and make the deal still work. And so I think diversification, even if it's just like knowledge diversification, is really important because it allows you to analyze deals in different ways. It allows you to be creative when you do get stuck in a deal. So yeah, I think it's critical, just like you would with stocks and bonds and real estate. Within the real estate submarket, I think it's important to have multiple exit strategies, multiple levers that you're pulling.
Hmm. I'm so glad you said that because I'm doing a presentation at the next House Hacker Mafia meetup in December about real estate portfolio diversity on having different strategies and different exit strategies for all your properties. So I'm going to clip that and send it to everyone so then they'll come and check it out.
There you go. Yeah, I think it's super important. A lot of people will tell you like, hey, just focus on one area. And I do agree that that's true, but I think having the experience at least of I've done multiple different types. I've done a flip, I've done renovations, I've done, midterm or short term or whatever it may be. I think having the experience at least helps you in a lot of ways. So I
Yeah.
totally agree with that.
So let's get into midterm rentals. Did you plan to do all these midterm rentals from the start, or did you plan long term and like, okay, let's learn a little bit about the furnished rental space, and what are your thoughts on that?
Yeah. So our first midterm rental was a mistake. I'll just be transparent there. We bought a property that we wanted to build out an ADU. We wanted to build out a cottage, and we this was early on in our investment journey, and so we think we know everything, but we ended up not knowing everything, and so we missed the fact that our lot was too small to build
Mm,
out an ADU. We had already bought the property, and we had run numbers to where we were going to live in it, short-term rent the back house while we were living in it and cover our mortgage. And then when we moved out, the house and the ADU was going to be enough long-term rental wise to cover our mortgage. But because we never were able to build out that cottage, renting out the single family house was not going to be enough to cover the mortgage long-term rent wise.
mm,
Um,
okay.
and the house wasn't in an area that was short-term eligible. We have some restrictions in Colorado Springs where only certain areas of the city now are eligible for new short-term rentals, and so we had to pivot at that point. And the easiest or the thing that we knew, I guess, the most about at that point, just from blogs and podcasts and some of the other people in our house hacking group had shared, that was midterm rentals. So we left a lot of our furniture in there. We bought some furniture new, and we started off our first midterm rental. And after a year, we said, hey, let's give it a year trial period. If it doesn't work out, we can either sell the property or we can try and just go back to long-term rental and maybe lose a couple $100 a month and just be okay with what it is. But after a year, we analyzed the numbers and we realized that we actually had done really, really well with the midterm rental the way it was. It wasn't as much work as a short-term rental, and there was so much more upside than a long-term rental. And so that was our first experience. We've carried that over into a couple more midterm rentals, and we've had great success with all of them. They're all varying sizes. One's a 3-bed, 2-bath house. One's a little 1-bedroom apartment. We have a 4-bedroom house in there. So we've gotten experience with kind of all sizes of these midterm rentals. And I think there's a lot of opportunity here where most people wouldn't default to a midterm rental.
Yeah.
They might, analyze the deal based on short term. But I think because of that, and because people aren't flocking towards the midterm space, there is a lot of opportunity that can be made. So yeah, that's a little bit of how we got started
Mm.
in that space.
Do you think like if someone were to buy a midterm rental now, would would they ideally go for like a larger property in order to make the more revenue based off where rates are at compared to a smaller property to make the numbers make sense?
Yes, I would say that in general, the larger properties are going to bring in a lot more. With that said, midterm rentals are somewhat unique. In the short-term space, yes, it's kind of one to one. The more bedrooms you have, the more revenue you're going to bring in. With the midterm space, there's probably a cap. So I think after you get past 4 bedrooms, if you're hitting that 5, 6 bedroom area, you're kind of in the gray zone where your target market, you're reducing your target market quite a bit because most midterms, we rely on traveling nurses, we rely on contractors, people who are displaced from insurance claims, say their house burns down and they need some place to stay, or corporate rentals, right, where
Yeah.
somebody's traveling for business for a month or two and they need a place to stay. So if you get into the larger echelon of homes, 5, 6 bedrooms, actually cutting out quite a bit of your target market for midterms. The
Mm-hmm.
single traveling nurse or the single corporate rental. So yes, I will say bigger bigger houses are better to buy, but there is a cap, and I probably wouldn't go above 5 or 6 bedrooms, or probably wouldn't go above 4 bedrooms, in
Yeah.
fact.
hmm Um, how do you find a lot of the tenants for your midterm rentals?
So the strategy that we've taken, and I'm not saying that it's 100% the right strategy, but it's worked really well for us. We market on a few different places, the primary one being Airbnb. And I'd say Airbnb probably accounts for 80% of our bookings on midterm. And the reason we've done Airbnb is because you can get, there are other sites like Furnish Finder, which we're also on, and I'll explain that here in a second. But the more you treat your midterm rental as a short-term rental, um, the higher revenue you can make. So um, there's there's a lot of people, there's a lot of competition out there in the midterm space that they don't do professional photos. They kind of treat it as a long-term rental. There's no real design taste, and their prices are a lot lower. But if you can add the amenities that you would have in a short-term rental, if you can add the communication, so automated messaging, responsiveness, these are just basic things that you provide most short-term rentals, but
Yeah.
you'd be surprised at how many midterms don't actually have good communication. So if you can provide those things, good amenities, like I mentioned, and then you can mix that with really good design on your property and professional photos and things that are going to stand out to the traveling nurse, to the corporate rental, to the family that's going to be displaced for 6 months. If you can do all that, there's a higher likelihood that you're going to increase your revenue pretty significantly. So, yeah, like I said, we'll market on Airbnb primarily. That's where we get about 80% of our bookings. We also market on Furnish Finder. I will say that the guests and the tenants that reach out on Furnish Finder typically expect a lower price. Now,
Mm,
that's not always a bad thing because
yeah.
on Furnish Finder um, you don't need to pay Airbnb fees. So you're saving quite a bit of money there, but it is a little bit more work on your end because you have to actually do more vetting. You have to do credit checks, background checks. You have to write up the contract, and you don't have as much coverage as you would with a guest on Airbnb, where if they trash your place, you can submit a claim against them.
Okay.
So
Mm,
I'd say those two, Airbnb, Furnish Finder, are the biggest ones. You can list on Zillow, you can list on Facebook Marketplace. Those ones we've had a little bit less luck with. Um, and that might change. I think the trends in the midterm space are always changing. I think 2, 3 years ago, Furnish Finder was pretty much heavily the top rated midterm site. And I think it's shifted quite a bit to Airbnb. We're listed on VRBO as well. But again, those other sites, VRBO, Zillow, Facebook Marketplace, are a much smaller subset of our total tenants
mhm.
that
Have
we
you heard
get in the
of
midterm space.
Have you heard of 30-day stay? That website?
I have, and that again, that's a new one, and it's another one that could be up and coming, and I think it depends on how much work you want to put into marketing your place.
hmm
If you're getting rented out pretty well with a few sites, it may not be worth to go on all of these other ones. But my motto and our idea is we'd always rather have more marketing on our side than not.
Yeah.
And so, yeah, sites like that are a great place to post your listing as
hmm
well.
I know the one of the owners of it. They are based out of Denver actually, and they're starting it in Denver and slowly going to other places. But
Oh,
I
nice.
don't remember if they've gone live yet. Yet for it. But just another site. I'm curious to see
Yeah,
how it's going to do because they're trying to stand out as being the place to go to for midterm rentals, 30 plus stays. Because Furnish
yeah,
Finder people always struggle with that one, and Airbnb seems to get everything nowadays. So having a good
totally.
variety would be very beneficial.
Yep, yeah, that's awesome. I'll have to check it out more as soon as it goes live.
Yeah. Um, for your tenant screening process on Airbnb, there's none basically. Do you just kind of accept the booking for whoever goes through because Airbnb has such a good insurance policy for coverage if anything goes wrong?
Yeah, we're still careful and we vet just like we would with a short-term guest. So, um, I think the thing I would say with this is we want to make our place as easily bookable as possible. We don't want to put too many restrictions, and the people that are searching on Airbnb are typically the type that want to book quickly. They want to have everything automated. And so if you have a bunch of restrictions on those guests, you're just not going to get any reservations. So if you're saying, hey, everybody who goes through Airbnb needs a credit check and a background check and all these different things, you might be wasting your time or spinning your wheels trying to get guests through that. And so what we do with Airbnb is similar to our short-term rental process. If they have a few five-star reviews, we'll typically just vet the reason why they're coming and then accept them. Airbnb collects payment, they manage all of that. And so if there's any payment issues, they're going to be dealing with that on your behalf. They also have huge liability that they offer you. And so if, for example, your couch was ruined or some other piece of furniture in your house was ruined, you can actually submit claims. So there's no real need with Airbnb to even collect a security deposit because that security is kind of built into the platform.
Hmm.
So the vetting is pretty simple. We send just and I would suggest this, just a brief rental agreement that can be signed after a reservation is made. And this is pretty typical too for short-term rentals. And that just covers anything extra that
Yeah.
may not be in an Airbnb agreement,
Hmm.
but that would be in a long-term rental agreement.
Do you have any like major challenges that come up with midterm rentals? I feel like the biggest one is vetting the tenants that are coming in, and if you have good communication, you seem like you'd be in a pretty good spot.
Yeah, there is one major issue that we see with guests that are coming through Airbnb. A lot of times, the person who's booking the reservation is booking on behalf of the person who's actually staying. So there's
Hmm.
oftentimes a communication gap. So an insurance provider is going to go make a reservation for somebody who's submitted a claim, right? Whose house burned down, let's say. Or you have a boss who's going to make a reservation for a few of their employees who are on corporate travel for 2 months. So a lot of times the communication is us going through whoever booked the reservation, and then that has to be translated down to whoever's um, actually staying at the property. So there's a few ways around that. One is just to be upfront and make sure to collect all the contact information for all the guests at the property, because you can't really rely on your communication going through another party and then to
Yeah.
the people who are staying at the property. Airbnb has a new feature now that multiple people can be added to the reservation, and so that's been really helpful. So we don't necessarily have to collect phone numbers and emails of these people anymore. It just goes straight through Airbnb, and they can actually be added on the reservation. So that's probably one hiccup with the communication with midterms. And then the other thing is just the vetting process if you're not going through Airbnb. So if you're going through Furnish Finder, you're actually looking at more of a traditional long-term tenant screening. And that's when we do background checks, we do credit reports, and we have them sign a full lease because we want to make sure that we're covering ourselves and we don't have the platform like Airbnb that's kind of adding that liability coverage on top for us. So that's when you have to be a little bit more careful and make sure that the people that you're placing in your property actually have enough in terms of financial stability to be able to pay and security deposit to be able to cover any issues that come up
Hmm.
on the property during their stay.
When you were first buying your midterm rentals, I'm sure you learned this after you made your mistake on the first one. But how were you analyzing and then getting estimates of like, oh, this is what I could rent this property out for?
Yeah, it's a little difficult because, like I said, if you go through Furnish Finder and you go and try and pull comps on a midterm rental, you're gonna pull comps that are barely above long-term rates.
Yeah.
Um, and the main reason for that is just these properties are so bad that nobody wants to rent them above long-term rates. So, and then if you go on Airbnb and you look at comps there, it's also going to be a little bit tough because you're going to have mixed in competition of all these short-term rentals that have way higher rates than you. So I think a rule of thumb is about 1.5 times what you would get on your long-term rates for the property.
Okay.
With that said, it's very seasonal, and I think that's where a lot of people doing midterm rentals might go wrong. They'll have a flat rate across the whole year, so one monthly rate, say 3,000 a month every single month through the whole year, but they're missing out on the seasonality that we also see in short-term rentals. So for Colorado Springs, our seasonality is very high, high demand in the summer, and our rates will almost double, almost triple during some months what our rates are in the winter. And so what we've done with our pricing for midterm rentals is we've actually added daily pricing. We use a software called Price Labs for our short-term rentals, and we also use it for our midterm rentals. And it sets daily rates just like you would for short-term. And I think the reason that's important is because you're going to capitalize on all of the holidays, you're going to capitalize on all the high times, all the in-demand days, just like you would a short-term rental. And you're going to make sure that your prices are dynamic so that you're
Yeah.
maximizing the revenue over the course of the year. So I think that's a big thing that we've learned over the past couple of years doing midterms is if we can have these daily rates and then put heavy, we basically price our daily rates as if it was a short-term rental, and then we add heavy monthly discounts on whatever platform we're on, Airbnb or Furnish Finder.
Yeah. Would you say location is very important for a midterm rental, and where are the good spots around Colorado Springs?
Yes, I would say location is pretty key. We have a lot of nurses, especially that stay at our properties, and the question that we always get asked is, "Hey, how close are you to this hospital?" And if you can be central, we have a lot of hospitals in Colorado Springs. Whatever city you're in, if you can be central to a hospital, that's like number one priority for a midterm rental because a lot of your tenants, a lot of your guests are going to be traveling nurses. But with that said, the location, as long as you're close to main attractions, the location doesn't have to be near a hospital. We have a lot of people that are coming to stay at our place and working at the Olympic Training Center or coming for a month-long symposium at the Broadmoor or other main attractions. So whatever big attractions are in your city, big places of work, whether it's, we have a lot of Air Force bases here, we have an Army base here. If you're close to big attractions where people are going to have to work or people are going to want to come and stay and visit for a while, I think those are keys. So just like you would with a long-term rental or a short-term, you probably can't go wrong. If you'd buy a short-term rental in that place, a midterm rental is probably going to be okay as well.
Yeah. What would you say the big hospitals are in Colorado Springs? Is it like St. Francis, UC Health? I know is up north. Is like Memorial and Primrose? Are those kind of the big four?
Yeah, we have the two downtown, Memorial and Penrose south, and then we have St. Francis up north, and then Memorial north.
Okay.
And both of those are kind of in clusters. If you can either have your property downtown, like in between those two, or your property up by Memorial and St. Francis, those are both like optimal locations. And we have a few friends who have midterm properties not downtown, but actually up north off Powers near St. Francis, and they have plenty of guests. And their clientele is actually a little bit different because there's a lot of new builds being built up there, and so a lot
Mm-hmm.
of families are having their homes built, and they need a place to stay in the time that their house is being built. So they'll go book a midterm rental, something that's furnished while their house is
Interesting.
being built.
Yeah.
Yeah,
Huh.
so different pockets in each city where you're actually going to get different clientele. So if you're appealing to travel nurses, which is probably the most common in midterm, definitely stay near a hospital. But there's so many creative ways you can do it.
Okay, we're gonna pivot away from midterm rentals. For your portfolio as a whole, you got like seven-ish properties and a few others. How did you scale? Were you house hacking each one, or how did you get the money, or did you borrow with partners, and what did that look like?
Yeah, so I think like we were talking about a little bit in the beginning, the snowball starts very slow. The first property that we bought, it was just saving up for our down payment and let's buy this property. The second property, even the same, saving up with our W-2 income, and then let's buy this property. Mixed in there, we did a couple of flips, like I was mentioning, where we thought this is too slow to actually save up for each down payment. So how can we supercharge this? How can we go a little bit quicker? And that's when we started getting into flips. So we would take equity from our HELOCs, put it into these flips, make 30 to 40K on that flip, and then use it for a down payment. We've also done house hacking. So in the last couple of properties that we've lived in, that is a great way to save a lot quicker than you normally would because you don't have a mortgage payment. Whether it's people who are living in your property, like in your actual house. I know a lot of people who have had roommates in their house. We had roommates for probably 9 months at one point in one of our properties, and it was great. And if you're willing to do that, if you're willing to kind of sacrifice a little bit, I think that's when the snowball really starts to get going, and that's when you can make big strides in what you're trying to save or what you're trying to accomplish. So house hacking has definitely helped. It's kind of helped supercharge our investment journey. And then the other thing I would say is partnership has been a huge thing. Like I mentioned, we bought a 7-unit apartment building back in 2021, and we partnered with one of my good friends that I grew up with, and I work with him, and he brought most of the money for that deal, and we brought most of the work. So we did all the deal finding, we did all the renovations on the property, we did all the management for a while there, and that allowed us to get the experience that we wanted to get with a larger multifamily property and a commercial deal. But it allowed us to do that without needing the capital that you would normally need, a couple $100,000 maybe for some of these deals. And so creative ways to partner have been a huge learning curve for us, and a huge benefit to us. And then even with this motel deal that I know we'll talk about here in a second, partnership in that too has been huge because not only does it allow you to reduce the amount of money that you need to bring to a deal, but it also reduces the amount of knowledge or the amount of risk that you need to take for a specific deal. So I think going forward, we've built up quite a few smaller single family homes and smaller multifamily homes in our personal portfolio, but I don't know if I would do another deal that is not a partnership at this point, just because of the benefits, the risk that you split, the knowledge that you get to split, and the capital that you can reduce, the capital requirements that you can reduce on a property.
Would you say that you would only do like larger deals nowadays and like partner and do like more hotels, or would you still do like a small single family MTR but just partner with someone on it?
I would do, I'm leaning towards larger deals in this moment, and I think the reason for that, partially personal reasons, because it's a lot of work to manage a single house as opposed to a single building that has maybe 25 units. And I think we're getting to the point where we want to scale past just the single houses that we have. Now, I'm not saying that we're going to abandon the midterm space. I'm not saying we're going to abandon our long-term rentals. Mm-hmm. Now we can use those strategies and apply them to larger deals, which we're really excited about. But I think it's going to allow us to kind of scale our time a little bit better too, because managing so many little things is very time consuming.
Mm-hmm. Would you say that's like exactly what your thoughts were and why you got into doing the 7-unit, and then it gave you the experience to get into the hotel?
Yeah, I think it's kind of like stepping stones. The 7-unit was a stepping stone into some of the bigger deals that we wanted to do between my wife and I. And when you get into some of these bigger deals, you realize that anybody can do them, but you're taken a little bit more seriously when you have some lower level experience. So when we were going to qualify for a loan for a 7-unit property, they asked, "Hey, what's your experience?" And at that point, we could say, we've done some single family or some very small multifamily properties, and we've done some flips. And, that was just enough to get us qualified for a 7-unit commercial loan. And then when we went to do this 25-unit motel, they were asking what's our experience, and you can use that now experience with our 7 unit apartment building and say, hey, we've done a small commercial deal before. Here's what we did with it. Here's the cap rate we bought it at and how we increased it and improved it. And then you can take that into the next deal, and you're a little bit more qualified. And so, yes, it's part of it is, hey, let's get away from these smaller deals. And the other part is let's get stepping stones into what we ultimately want to do, which was these larger hospitality properties.
Hmm. How did you end up finding this motel? And it's in Durango, right?
Yep, it's in Durango, Colorado, and we found it. It was on market, and there's always an emphasis on, oh, can you find stuff off market? But what I'd say in the commercial space is these deals are pretty hard to close. So even on market, you can find some really good deals. And there's a lot of opportunity for creative financing just because these are much harder to close than a single family house. The financing is different with banks. Lenders treat them less favorably in a lot of ways. And so there's room for seller financing in most of these cases. You can go pick, maybe a handful out of every on market, a handful of properties on market in your area. And I bet if you contacted the sellers, a majority of them would be open to seller financing. So we found it on market, reached out to the seller. They had some interest. They, had popped in and out of contract a few times. But again, these deals are difficult to close because of the lending requirements. And so we negotiated quite a bit. We found a really good lender. We got a lot of no's. We probably called 40 plus individual lenders for this motel deal, and everybody said no, 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 no. We don't lend on hospitality, or no, this this doesn't meet our requirements, whatever it may be. But we finally found a really good lender that we worked with, and they were able to get this deal closed for us.
Jordan, your partner on this deal, he actually just presented at the recent meetup we had. So if anyone wants to hear more in depth about that, they can learn about it there. And I think Jordan was saying that even the lender that was currently had the loan on the property wouldn't even lend to you on it. Is that right?
Yeah, exactly right. And a lot of people might be scared and say, okay, well, why aren't all these lenders lending on this property? It's probably not a good one to invest in. But you just have to realize when you get to that level of commercial space, each bank only has a certain quota that they, a quota of hospitality deals or a quota of hotels that they can add to their portfolio. And so a lot of them have very, as they get closer to those quota limits, they have very strict requirements onto what they can actually put into those portfolios, what they can lend on. And so you just have to find the right one. You have to be persistent. And luckily we were able to with this deal.
Mm-hmm. Awesome.
Yeah.
So everything we've talked about has been fantastic so far, but leave us with a good motivational quote that you really like that has helped you through your real estate journey so far.
Yeah. I was thinking about this. I think this one's a unique quote. It's from the Bible. It's Proverbs 22:1, and it's not about real estate specifically, but I think it goes back to my original point that I was talking about with my grandpa. So I'll give you the quote first. It's a good name is more desirable than great riches. To be esteemed is better than silver or gold. And I think it's important to keep that in mind. It's definitely something I've tried to keep in mind as we've built our portfolio and as we've grown in our real estate journey, is that, you can have all of these riches, you can keep building, you can have all these properties, but at the end of the day, if your name is tainted because of how you treat people or because of the things that you do in your business, you're going to be virtually broke, right? You're going to be spiritually broke. And so it's something I like to keep in mind with every decision we make. Is this honoring people? Is this being generous to people? Is this building up a good name, or is it just building up riches in my family's name? And I think that's something that we've tried to keep at the forefront of our minds. And, going back to my grandpa's funeral, right? He didn't take any of his properties with him at the end of the day. But what lasted and what stuck around was the way that he impacted the people around him, the way that he impacted his tenants, his employees, his business partners. So that's the reason I bring up that
Mhm.
specific quote, and I really like that
Yeah.
verse. So
I think it also ties into how you operate your midterm and your short-term rentals too, of giving people a good experience and when they're
right,
coming to a city they've never been to before, and making sure that they're well taken care of, and they have a good person to rely on, ask questions if they ever are in a
100%,
situation. So fantastic.
100%. Yep.
If anyone wants to reach out to you and ask any questions about midterm rentals, what you're working on, where can they find you at?
Yeah, I'm not on a lot of social media, but I am on LinkedIn. You can find me Conor Gatlin on LinkedIn, and I'm happy to connect if anybody's interested.
Hmm. Awesome, sweet. Thank you, Connor. That was awesome.
Yeah, thanks, Tanner.
Thanks for watching, everyone. I hope you enjoyed this episode. If you have any questions or you want to come to a real estate meetup that we host, send me a message. You can find me on Instagram, YouTube, any ways that you are. Oh my God, what the fuck? Thanks for watching this episode, everyone. If you have any questions about midterm rentals, short term rentals, any type of investment style, come out to our real estate meetup. We host it 2 times every single month. You can send me a message on Instagram or YouTube because we are here to help you on your real estate journey to be getting financially free, growing the wealth that you want through real estate. So please reach out.